Happy Tuesday out there, Team 42 is your skipper here, Darius to present our macro minute for Tuesday, September 24th, 2024. As always, we'll start with the executive summary from today's lit-off morning note. If you'd like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how will China's easing impact asset markets? Our answers are PBOC Governor Pan Gongsheng used today's rare tri-agency press conference to unveil a sweeping 10-point package that will likely provide a transitory boost to growth and investor sentiment in China. These announcements contributed to the best single-day performance in the benchmark CSI 300 index since July of 2020. It was up 4.3%. Investors will be remiss to do anything other than participate on the long side of Chinese equities and international cyclicals over at least the next few months. Beyond that, we see China's structural debt and demographic headwinds as requiring substantially more stimulus to offset. The CCP's decision to accelerate support of the Chinese economy suggests the current Goldilocks market regime is likely to persist or at least dominate from a frequency perspective over a medium-term time horizon. Of our four active fundamental themes, three are explicitly bullish for asset markets, specifically our resilient U.S. economy, Jay wants a soft landing, and here comes the liquidity themes, the latter of which China is playing a key role in. Our lone fundamental theme that may contribute to the development of a trending risk-off market regime, i.e. sticky inflation, is unlikely to have market impact until the Fed downgrades the labor market in its reaction function, which may not occur until economic resiliency is confirmed by data well into 2025. Transitioning to our 42 macro dashboard, as always, we'll wrap up the question from our community. This one's regarding yield curve disinversion. So with regard to the view of Goldilocks persisting well into 2025, does the yield curve disinverting due to Fed cuts threaten that as it could signal a recession? Do you just view that as one signal and could see a recession as much further off based on signals relating to the business cycle? Thank you. So the client sort of answers the questions already. So the answer is yes, we only view the disinversion in the yield curve as one signal. As you know, we've done a deep dive proprietary study on how the business cycle works. It's one of the biggest empirical studies I've seen out there in terms of helping investors understand how the business cycle works and, more importantly, where they are at any given time in the business cycle. And that analysis continues to suggest that there is unlikely to be a recession over a medium-term time horizon in the U.S. economy. And for those who may be new to these macro minutes or to our research in general, when we're talking medium term, we're talking anything between 3 and 12 months. And so it's unlikely, given that condition, based on the current tracking of the persistent leading indicators of the business cycle, we do not view the disinversion of the yield curve as signaling a recession. We view the disinversion of the yield curve as signaling, is confirmatory of our view, of our expectation that nominal GDP in the U.S. economy is likely to surprise, generally and persistently surprise to the upside over the medium term. That's consistent with both our resilient U.S. economy and sticky inflation themes. And so ultimately, we do see some risk in price terms in the bond market, but ultimately that risk in price terms in the bond market is likely to catalyze a fund flow dynamic out of bonds and those types of securities and defensive assets like the U.S. dollar and into risk assets like credit, stocks, equities, crypto, et cetera. So that's been our view, and we maintain that view irrespective of the disinversion of the yield curve being brought on by the Fed's acceleration of rate cuts. So we'll wrap it up there. Darius presenting our macro minute for Tuesday, September 24th, 2024. Everyone have a wonderful day. Best of luck. Catch you back here tomorrow. Cheers.